A volatile week saw the Nifty and the Sensex snap its 3-week gaining streak, and by the end of the week we realized that the week started off very well at that 18,400 mark but gave up a lot of its gains through the course of the week. So clearly some resistance was faced at higher levels. Now on this week's episode of Editors Roundtable, we're going to be speaking to a very special guest on the markets. We'll also take stock of the SEBI's consultation paper on the expense ratio norms for mutual funds. We put the spotlight on the growth of India's QSR space, and we'll also tell you why NSE has outperformed its global and domestic peers. I'm Sonia Shenoy, and with me are editors Nimesh, Prashant, Mangalam. Guys, this week was a bit of a downer, right? I mean, we started off well and all promised to hit lifetime highs, but then through the course of the week, it just kind of fizzled out.
We hit lifetime highs, right?
Yeah.
Within 10 paisa of lifetime highs on the Bank Nifty, and then the market did nothing. But I think last session, which is Friday's session, has kept hopes alive that this is still a pullback, what we've seen over the last 4 days, and the broader uptrend is still intact. The range has been 18,100 to 18,400. So it's neither here nor there. We're still kind of hoping that the market comes back.
What's helping the bulls is the fact that the FIs are still net buyers. And I explained last week as well. Till the time the FIs are net buyers, you'll see the outperformance of mid-cap and small caps. And that's where the investors are quite happy. A lot of stocks in the mid-cap and small cap, even this week, very, very range-bound market has outperformed and have done well. So looks like the momentum in the mid-cap and small cap continues. The FI buying continues. The fact that, we were on the one side of everybody trying to be on the long, I guess we just cleaned out some of those, daily traders this week. So that's a good healthy sign, I believe, this whole correction.
And, another thing that really stood out for me this week was that large cap earnings were quite good. Yeah. Whether it was SBI, ITC, you had Bata. At the start of the week, there was Bharti Airtel. Despite all the, challenging data points, the challenging environment, Bharti Airtel was not bad. So in that context, even in the fag end of the earnings season, we had pretty decent earnings.
Yeah, but if you just look at the Nifty point to point, you would say, yes, it snapped a 3-week winning streak, etc. But on a daily basis, there was so much rigmarole happening It was a bit of a drag at most times. The afternoons were a little, where you saw the markets start to slide. And thereafter, the next week is the expiry. So let's see whether this was the week where everyone took a pause, and maybe the expiry week is where we actually see the lifetime highs or not, because it's the May monthly expiry. What happens to sell in May and go away?
Yeah, actually, what happened to that? I mean, none of that played out. We, in fact, have Sameer Arora joining us as well, the founder and fund manager at Helios Capital. So, Sameer, welcome to the show. How are you feeling about India now? Because, it's kind of like a situation where you're struggling at higher levels, struggling to get above those all-time highs for India. But give and take everything, global markets have been doing pretty well.
But overall, I've been feeling good. And I've been actually feeling good for this whole year, but except that January was quite bad otherwise. But broadly speaking, I think I now carry only one line story for the world, which is that India is a big beneficiary of China +1. It is simple to carry that message, simple to believe it, simple to prove it, but not simple to bet on it in the sense of specific stocks, but big picture in terms of FII flows, big picture in terms of FDI or supply chain. It's just easy to understand, and I am, going with that one line for the next few months. Let's see how it goes.
Sameer, how high is the book tower behind you? I mean, the screen cuts it off, so we can't.
Yes, I'm home, so I have 2 towers at home and 2 in office. And then
Sorry, what is that?
I have 2 towers at home and 2 in office. Actually, 3 office. Oh, sorry, 2. I mean, it's like a different shape, so it looks bigger. But broadly, yeah, these mostly are not finance books. These are mostly Grisham type.
That's where you learn more. Finance books are good to read and then speak about and sound intelligent, but the books where you learn more are the non-finance books, for sure.
So, Sameer, what are you reading now?
Business book I take to office and keep it there. What I'm reading right now is actually Outlive, which is another version of what I sent you guys, which was Lifespan. So this is Outlive, which is much more readable. And I am trying to implement some of it, like cutting down on sugar to near zero.
That's a lifelong plan, right? To try and cut down on sugar.
I've actually done it. I've done it for about a month and a half.
Wow. Great. Good for you. Good for you. I'm still struggling. But you know what? Let me do one thing. All of us have to, right? Stay fit, except Mangalam, of course.
No,
he's the one who's
to.
like staying fit as ever, right?
I don't know it.
But okay, he's going to give us some fitness tips in a bit. Before that, SEBI released a consultation paper this week about what's happening with the mutual fund industry and the total expense ratio and all of that. Prashant, tell me frankly, did you read the whole paper?
From fitness and whatnot to, boring TER and expense ratios.
That was a great segue.
But I did read it. I read it yesterday and I went to sleep at about 1 or so. It was a long 40-page paper. So let me just go across to the big wall and tell you what really happened. So SEBI is basically asking mutual funds to cut costs for investors, really. So this is basically what they're saying. This is the crux of what they're saying. And let me explain how SEBI plans to implement this. The consultation paper came out yesterday evening. So what SEBI is saying is, whatever is outside of the total expense ratio is basically the money that mutual funds make. Whatever and what is charged to investors. SEBI is saying things like transaction costs, which is brokerage, etc., taxes that you pay to the government, which is charged over and above the base total expense ratio, you bring all that within the TER. Total should mean total. There is nothing called total plus plus plus. Total expense ratio should include everything. Now, the way it's going to do this is that it's proposing new expense slabs for equity and non-equity AUM. The silver lining is that it's allowed the TER, the total expense ratio, to go up a little bit. The fear was, and by the way, this is not new because the SEBI chairman has spoken about this. There have been news articles. It was much anticipated. The fear was that AMCs would be asked to subsume a lot of these additional charges within what they were charging, which is not the case because TER slabs have been lifted a little bit as compared to earlier. I'll get to the percentage levels in just a bit. The other important change is that the slab will be at the AMC level and not at a scheme level. So a scheme can have, say, 2,500, 3,000 crores in assets, but it will not be, the AMC will not charge according to that slab. It will charge at the overall equity AUM level of the AMC, and that is important. Another interesting thing, AMCs have been given the option. This is, of course, a suggestion. Feedback is sought. They can set up terminals, trading terminals in their own offices and deal and execute their own trades. This is as a counter to mutual funds who say that, this will mean that we have to spend more, we can't charge. They're saying, well, trade on your own, don't go through brokers and cut costs. I don't know how practical that is. And they've also introduced the concept of a variable performance-linked total expense ratio. Again, a suggestion, something to be debated, deliberated upon. They're saying that you've got 12 days to kind of send in feedback. So 1st of June is when is the last date to send feedback in. And after that, in a graded manner, within 6 months, all these proposals will be implemented. Let's have the first table, which will tell you how this works, right? It looks complicated. It is not. But basically, the ceiling, the maximum total expense ratio that mutual funds can now charge is 2.55%. There you go. It was earlier 2.25%. So 2.25 has gone up to 2.55. And as the size of AUM goes higher and higher, becomes bigger and bigger, what you can charge becomes lower and lower. Makes sense, right? This is a non-linear business. Costs don't go up as the AUM goes up. So this is basically the first table I wanted to put out. SEBI has made an estimation of what this will, what the hit for the mutual fund industry will be, if you can have the next one up. And that is 4.5% in percentage terms at the industry level. This is the total hit that the industry will take. And then I want to just put out another table, which SEBI has put out in its paper. This is, they've taken 5 cases. The second column is for example, if one AMC A is charging 1.8% in total expense ratio, under the new rules, it will become 1.64%. The drop is 9% and so on and so forth, as you can see. These are hypothetical cases that SEBI itself has put in its discussion paper. Now, these are also listed companies, right? AMCs themselves. And CLSA is estimating that assuming no pass-through for companies like HDFC AMC and Nippon AMC, this will be the impact. If you assume some pass-through, which is mutual funds will ask brokers to share some of the burden, distributors to share some of the burden, the impact will be lesser, but there will be impact nevertheless. Let me actually throw it across to Sameer, who's with us. Sameer, you are in the mutual fund business now, and for you, this is good news. You can charge 2.55% at least to start with. Your thoughts?
First of all, we are not in the mutual fund business
will be.
yet. Yes, hopefully someday soon. But the thing is, I think this brokerage being included in TR is first time I've heard. Never seen it in US when I was in the mutual fund industry or in Singapore. Because there, there it's not that all funds have to be Warren Buffett kind. Actually, even Warren Buffett trades a lot. But let's say buy and hold so that the brokerage that is being paid is unfair. It might have been better to say that the brokerage per broker cannot be more than X basis point, maybe 6 basis points or something. But basically, if you make the fund manager every time think that should he do the trade or not because it's going to come out of his pocket, I don't think that is needed. Plus, I don't know, I've never been a broker, but I don't think it is so straightforward for fund managers to set up brokerages, bringing another set of organizational issues and risk issues and whatever else that brokers actually protect us from also in some sense. It might have been just better to where whatever was bugging the regulator in terms of brokers either being paid too much brokerage in absolute or as percentage, all those could have been done, I think, without saying that the brokerage has to be included, because this definitely discourages many kinds of funds. And actually, one advantage of a mutual fund was that you could in theory do as much trading as you want and still have the tax benefit. So it's not that everybody has to be buy and forget kind of this thing. Other than that, we are actually benefited a little bit as in any new guys, because now the TR is at a firm level and therefore these old guys, their starting points will be lower, so making them less attractive for distributors maybe, who knows.
Right. Sameer, just on this itself, I guess one way to also look at it is that it is bringing more transparency to the investor, and as a result of which more people would enter the markets, more people would perhaps, increase their investment allocations, etc. through mutual funds. Is there a case to be made on this?
I don't agree with that actually, because I was asking some of these guys when we were thinking of how to approach the market whenever they get approval, that why do people go through distributors when you have a clear nearly a 1% or that range of difference between the direct class and that transparency, everybody can see that there is a 1% difference. That doesn't need any small print, and still 80-85% of people choose the distributor, which means this transparency that here that you're paying 1% more per annum for life, more or less. Still people choose that. So these small things, that whether this 5, 7, 10, 15, whatever basis points brokerage was taken by the fund or by the that, I don't think anybody's looking at it. I'm also an investor more than just being a fund manager. I don't think anybody sees what was the fee. They just look at net performance and go with that.
Absolutely. Okay, Sameer, there's another thing that we wanted to discuss, which is what happened with NSE, the National Stock Exchange. It's performed, the performance came through in the week gone by, and it's done better than most of its peers. So Nimesh has put together some data for us. Nimesh, over to you.
So now, better is maybe an understatement because they've done a blockbuster set of numbers. I'll just go to the wall and explain why I'm putting a spotlight on NSE. Though it's not listed yet, but a lot of investors are hoping that NSE will list very, very soon, and that's the hope for a lot of investors. But apart from the listing, let me put out the fact that what reporting numbers they've done for FY23. Let me first put out the Q4 numbers, which they reported earlier this week. The operating revenues were up 30% to almost 3,450 crores. The EBITDA grew by almost 25% to 2,500 crores, and the EBITDA margin was close to 74%. That was Q4. But look at FY23, the full year of NSE. In FY23, they've reported a revenue of 11,850 crores, which is a jump of 43%. On a YOY basis. The EBITDA grew by almost 42% to 9,300 crores, and the EBITDA margin was 78% in FY23. It reported an EPS of rupees 148 rupees per share. So that's the FY23 number for you. I just want to put into perspective what this means and what NSE is doing. It's the only major exchange in the world which has reported a growth of 35% both in revenue and in profit for the last 5 years. So it's been a consistent performer for the last 5 years. Now, I just wanted to put this, what it means in terms of perspective. NSE's growth in the last 5 years is 3.5 times of what the global average revenue growth has been. And in terms of profits, it's been 10 times more than what the global average across exchanges has been. So that's the kind of growth which NSE has shown in the last 5 years. Now, there are a few large global exchanges as well who've done really well and reported double-digit growth in revenue and profit. That includes names like London Stock Exchange, Euronext, and Deutsche. These are the few names who've reported double-digit growth. Now, in terms of valuations of NSE, in the unlisted market, the shares of NSE are quoting between 3,000 to 3,200 rupees, which means it's commanding a market cap of close to 1.5 lakh crore, between 1.5 to 1.6 lakh crore. On an FY23 earnings of 148, it is quoting between 20 to 21 times trailing FY23 EPS. Now, let me put this earnings into perspective of what the globally exchanges are trading and where NSE is trading. Look at the CME group. That's trading at a 24 times trailing price to earnings, whereas the 5-year growth is just 6%, and the profit growth is minus 8% for CME. Even if you look at the London Stock Exchange, it's trading at 60 times for a growth of 30% revenue on 5 years and 20% profit growth in 5 years. Hong Kong Stock Exchange is quoting at 36 times for a growth of just 7.5% in the last 5 years and a profit growth of just 6.5%. The average, if you look at the global averages, it's close to 27 times for a 5-year CAGR growth of 10% and a profit growth of just 4%. Vis-a-vis, NSE is trading at 21, 22 times. This is the global picture. Now, even if you look at NSE versus the Indian peers, the 4 listed exchanges, BSE is trading at 33 times for a 5-year CAGR growth of just 10%, and they've done a negative profit growth. In terms of MCX, that's quoting at 48 times for a growth of 5.5% and 2.5%, and IEX is trading at 46 times for a 5-year revenue growth of 14% and a profit growth of 21%. NSE is still trading at 21 times. So that's the whole idea. NSE for the last 5 years has seen massive growth, but still it is trading at just 21 times, trailing earnings. Again, the point is, while it's unlisted, a lot of investors are hoping that NSE will list very soon, and that could be a big trigger for a lot of investors who are holding on to NSE for a very long time.
Okay, Nimesh, thanks a lot for that. So big moves coming in terms of earnings for NSE. Let's do one thing. Let's take a short commercial break. On the other side, we'll also talk about the QSR space and how those companies have performed in Q4. Have they lost steam or have they picked up? We'll find out more on the other side. Stay with us.